Index funds and indexes that they're based on are generally considered to be more tax efficient than actively managed funds that trade a lot. We're fortunate today to have with us Joseph Nelesen from S&P Dow Jones Indices. Hi, Joe. How's it going?
Good. How are you?
Great. And Joe, you're Senior Director, Index Investment Strategy, correct?
That is correct.
Okay. And what we're going to talk about is your research series. I think our readers and clients are very familiar with S&P's SPIVA scorecards, looking at active versus index fund performance over long periods. I don't know if people realize that there's also a SPIVA after-tax scorecard. Could you talk a little bit about the reasons for doing that and the methodology?
Sure. And it's fair if they didn't realize it because it is a brand new report that we just put out last year for the first time. So if the readers are familiar with SPIVA, they'll know that we've been running at S&P Dow Jones Indices for 20 years now, a comparison of active versus passive. We've tried to follow the same methodology throughout, the same kind of reporting, so you have a really good comparison points year to year. And one of the the keys of that methodology is that it does incorporate fees into performance. And so we're reporting performance after fees for mutual funds. But one thing it has not included is the effects of taxes on the overall investor experience. And from time to time, we would repeatedly get the question of, what if we did a version of this after tax, meaning more specifically, if we calculate the impact of things like capital gains distributions that happen to mutual fund investors at the end of the year, for which they are taxed, but they maybe just don't necessarily see an actual distribution of cash, but there are also dividends throughout the year, all sorts of distributions that spin off of a mutual fund structure that are in a taxable account anyway, uh, generating tax bills for those investors. And so if you look at the overall investor return after taxes, it would be slightly lower.
Okay.
So
Um, just let me ask you, how do you do that? Because you have people living in all across the country. You
right.
have different tax brackets. How did your methodology kind of weed this out?
So the good news is there's already a widely agreed upon methodology that was set in place around 2001 by the SEC. If you look deep in the fund documents of any mutual fund, they have to report post-tax returns using this approach. And what it does is generally just assumes the highest tax bracket, for example, for distributions that would be taxable at that rate. Capital gains would change over time as they have through different periods. There's a few slightly different tax rates that apply, but we use that approach. And so we really took a standardized approach that allows at the fund level each of the funds that we analyze to really match the way they are already reporting themselves. We just aggregate those data in a way that allows us to compare the performance by category after tax to our benchmarks, which, and here's the key thing, we also tax affect the benchmarks, meaning we'll take the dividends that come out of the benchmarks, tax them at the same methodology tax rates, and their performance is slightly impaired as well.
Okay. And these are all long-term capital gains, I assume.
Yes, although, well, in most cases, we do have from our data provider very precise categorization of the distributions. So on a daily basis. So we're actually following a protocol of assuming the tax implication every single day at the type of distribution using the tax rate that was in effect on that day for that type. So most of the time it's long term, but there are some gains that are designated as short term and we treat them as such.
So you look at short-term and long-term going back as far as 20 years, correct?
That is correct, 20 years.
Okay. The everyone assumes, and other research reports have shown this over the years, that index funds and indexes are generally just going to provide more consistent and tax efficient performance numbers and returns. than actively managed funds, which makes sense because actively managed funds, by their very nature, are going to trade a lot more, or at least some more. Did your research quantify this? Is that pretty much what you found too?
I think we do find that. I mean, we use the indices, the S&P 1500 and the S&P 500 in this report. So both of which are cap-weighted benchmarks, and we've compared those to a few different SPIVA categories, such as the all domestic funds category, and large cap core. And so we're talking about very broad U.S. equity categories where the benchmarks themselves do not have very much turnover, largely because they are cap weighted by design. So comparing that to the managers in those categories who typically do have much higher turnover, you'll start to see these differences that result from that kind of trading activity.
Okay. And so what's the bottom line here? What can you give us the big picture of what your research shows?
Sure. We are showing that when you consider the effect of taxes, which tend to impact mutual funds more than indexes or index products, the underperformance rate of active managers increases over every time horizon. In other words, the real investor experience is even more difficult in finding an outperforming active manager after tax than it is before tax. And I think some of the anecdotal examples we found of this are, in a year like 2022, for example, where the markets were broadly down across nearly every asset class, and people were presented with capital gains bills at the end of the year that impacted them from a tax perspective. Those were really painful moments, and those spur a lot of these kinds of questions and requests for this type of report, because those down periods often lead to outflow from funds. That outflow requires trading to meet those demands for money back, and those trades lead to gains. So this is a common phenomenon, and it's one that we've begun to quantify, and we will continue to do so.
Okay. And so the indexes, of course, aren't investable. They're benchmarks.
That's right.
So it's interesting to take that and to separate that from the actual fund performance. And your research shows that when you look at the actual performance numbers after tax, index funds show even more impressive outperformance over the average active manager, correct?
That's right. And the indexes are not, to you right, technically investable themselves. We all know there are myriad index products benchmarked to these indices. But what we do is we show index performance pre-tax and after tax. The pre-tax is just the plain, gross total return performance that we're used to seeing. After tax, as I mentioned, we take those distributions that come out from the stocks inside of the index, tax them accordingly, and recalculate that performance. And that's something you can see in the report as well. And the impact of it is much less than the after-tax impact for the mutual funds.
So that's very interesting, I think, for our listeners, because we're always talking about the academic basis for our strategies at IFA and the academic theory behind investing in index funds. What your research shows is, from practical perspective, there's even more for investors to gain on an everyday level by sticking to a consistent rules-based strategy.
Yeah, without giving direct investment advice, I think broadly we see these categorical differences, right, between active and passive. And that doesn't mean there aren't active outperformers. There always are. We never see 100% underperformance rates, right? Someone's beating the market. In fact, we would argue that the active management is really the side of the equation that's setting prices in the market, and passive is there as a way to participate in that overall market activity. But we do see this through our SPIVA work. As it has evolved over time, we've added different layers of analysis. For example, people are asking, what about fees? How much does fees make a difference? to respond to that, we did an institutional version that takes out fees, and we still find that the selection of stocks and bonds is challenging and leads to underperformance. Adding fees makes it even more challenging. Now, adding taxes, again, as another layer of underperformance. And so I think it all speaks to the way that we've seen a massive shift of strategies into index approaches. And not only the broad benchmark, but also things like, sectors, value, growth, et cetera. A lot of ways to achieve an outcome that can use so-called passive instruments to do so.
Okay. Thank you very much for your time.
Thank you. Always a pleasure.